All right, and we continue with looking at earnings. We now move into Sanghvi Movers. Now, they seem to have had strong Q1 earnings. The margins do have contracted year on year, and they are looking at a consolidated revenue of 1.4 to 1.45 crores. Let's go across to Rishi Sanghvi, who's now joining us. He's the MD of Sanghvi Movers. Hi, Mr. Sanghvi. Thank you for being with us. Now, Mr. Sanghvi, Saudi DSO is at 201 days. Now, what is really the collection action plan? And also, by when do you expect this to normalize to a sustainable sort of level?
So given the current situation in West Asia, we had temporarily experienced some delays in collections from our clients. However, in the month of July, the management has recovered significant payments from its customers, and the DSOs will normalize within a quarter or two.
Now, with Saudi fleet coming online only in Q3 or Q4 FY27, is the 1400-500 crore revenue guidance still achievable, or is there a down risk?
Of the total revenue guidance that we have given, which is between 1,400 to 1,500, less than 10% will come from Saudi. So the revenue growth is primarily driven by our India business, both the crane rental business as well as the renewable engineering and construction business.
All right, now the core crane rental EBITDA margin is at about 49%, but the blended margin is trending towards the 33 to 35% as ENC scales. Now, what really is your outlook for blended EBITDA margin?
So we have given a clear guidance for FY27 of a revenue of between 1400 to 1500 crore and an absolute growth in EBITDA between 525 to 575. This reflects a 30 to 40% growth on the top line and a 20 to 30% growth on the EBITDA. Now, while our crane rental business is a high EBITDA capex heavy business, our renewable business is an asset light, high ROCE business. So if you put these two businesses together, the blended EBITDA margin would tend towards the mid 35 to 40% target range.
You've disclosed a FY28 revenue growth target of 30 to 40%. Now, what are some operational milestones in FY27 that must be achieved to unlock that trajectory?
So we have a 5-year strategic roadmap, which is called Elevate 2030, which has given us the confidence to give a forward guidance for not only FY27, but also FY28. Now, some of the cornerstones of this is our international expansion in the Middle East, which is playing out as per our initial investment thesis. We are already cumulative EBITDA positive in our Saudi business. The engineering and construction business in the renewables is doubling every year. We started at 250 crores in 2024, and it has effectively doubled year on year. And this year, we would have deployed more than 1,000 crores in capex in the crane rental business, both in India and in the Middle East. So these are the operational milestones which will help us achieve this 30 to 40% growth in FY27 and a compounding growth of between 25 to 30% in FY28.
All right, now Sangreen's 680 crore order book in year one is impressive. So what really is the targeted order book size by the end of FY27? And also, what is the sustainable EBITDA margin?
Our opening order book at a group level was 1,053 crores, which was disclosed in May 2026. Now, across the last 10 weeks, this order book has grown by roughly to 20% to 1,200 crores. So we believe that in the crane rental business, this order book will sustain at a 52% EBITDA margin. And in the engineering and construction business, we will see an EBITDA between 10 to 12%.
All right, since we don't have the lifting capacity additions numbers over here, but can you at least give investors a directional sense of how much of the FY27 capex adds to tonnage versus replaces aging fleet?
Most of the capacity addition that we are doing is for incremental capacity and not replacement, because as you can see, we are already at 86% yield. So most of the old fleet is also deployed, and the new capacity will give incremental revenue. This year, based on the timing of the capex in the financial year, we believe that our capacity addition of roughly 652 crores, of which 90% is deployed in revenue generating capex, will add an incremental revenue between 10 to 15% for this financial year.
All right, Ms. Sanghvi, thank you so much for joining us today and answering all the questions. Thanks.